Welcome to the deep dive. When you hear about a transport business in trouble, you probably picture some kind of sudden crisis.
Yeah, a catastrophic event. A bank pulls the plug overnight or something.
Exactly. But the source material we're looking at today, it reveals something, well, a lot quieter and maybe a lot more dangerous.
It's rarely a bang. It's more of a slow bleed. The financial pressure, it doesn't build overnight. It creeps in.
How so?
Think about it. It's the effect of late payments from a key client just dragging on. Or diesel costs that suddenly spike and just shave a little bit off every single margin.
Or those unexpected repairs you could never really budget for.
Precisely. It's
Yeah.
that constant feeling that cash flow is tight, even when the books, the spreadsheets say you should be fine.
And that feeling, that gap between the paper and the reality, that's the central tension we're diving into. Because the core belief in this sector has always been that staying busy means staying profitable.
It's the default setting, isn't it?
Right. If the trucks are moving, if you're racking up the kilometers, you've got to be pulling out of the hole eventually.
And that is such a dangerous assumption. Because in an environment with thin margins and high volatility, which is, let's be honest, the reality for many operators right now.
High activity doesn't equal financial health.
Not at all. In fact, high activity can become a mask. It can hide a really deep structural strain. The business looks busy, it looks active, but underneath, the financial foundation is just cracking.
So our mission today is to look at financial restructuring, but not as some last-ditch desperate move.
No, not as a Hail Mary, but as the strategic intervention that it really is.
We're looking for that critical point, that nugget of knowledge that lets you step in before that downward spiral becomes, well, irreversible.
Exactly. We need to draw a clear line between temporary stress, a bad quarter, a big breakdown, and a genuine structural failure. And this is for you, listening, if you need to spot these signals early enough to act decisively.
Okay, let's start right there then. With those subtle warning signs, the sources point out that transport operators are, by their nature, incredibly resilient.
Oh, absolutely. They muscle through everything.
But that same resilience, that I can fix this attitude, can actually become a liability, right? Because it means they put off making the hard decisions.
It does. It really does.
So what are some of those common early warnings that people just, push aside?
Well, the research is clear that the most dangerous signs are the ones that have almost become normal. The most misleading one is that feeling we talked about.
The cash flow dissonance.
That's it. Your quarterly report looks healthy, but every single month it feels, excruciatingly tight to get by. That gap between the spreadsheet and the bank account, that's a massive red flag.
It's the ultimate aha moment, isn't it? When the data says green, but your gut is screaming red. Why does that happen?
It's often about timing and debt structure. Other warnings are things like leaning more and more on your overdraft.
Or other short-term finance.
Exactly. Just to make basic payments like fuel or payroll, you're basically paying a premium for cash you should already have. And then there's the big one, sliding on your statutory obligations.
Like VAT or PAYE?
Or even just the repayments on a trailer.
But hold on. If an operator is struggling, borrowing from the tax authority by delaying VAT or from the finance company, it probably feels like the only move they have left.
It does, in the moment. But the sources are really clear on this. That is the definition of compromising your structure. You are using capital you don't have from the future to cover today's costs.
It's not a solution, it's just delaying the problem.
It's making the problem bigger. And the last sign, which is maybe the most frustrating, is having loads that are theoretically profitable, but that profit never actually turns into usable cash in the bank.
Because of long debtor days or bad contract terms.
You got it.
So if I'm recognizing these patterns in my own business, the tight cash, leaning on debt, profit that isn't real, the conclusion from the material is that my problem isn't effort, it's structure.
Precisely. And no amount of willpower, no number of extra trips can fix a broken financial foundation.
Okay, that's a perfect lead into the mechanical paradox of this industry, because when that pressure mounts, the natural reaction is to just push harder.
Of course it is. More trips, more kilometers.
Maybe take on riskier loads because they promise a bigger payout.
It's a primal reaction. If you need more money, you do more work. But there's a psychological element here, too. A lot of operators, they double down on activity because they're in denial. Or they're just hoping that one big contract will fix everything.
They're afraid to slow down and actually confront the broken structure.
That's it. And that fear makes them ignore a really counterintuitive point. On the surface, more activity means more income, right?
Right.
But the analysis shows this can actually speed up the decline. It can push the company towards failure even faster.
How does that work?
Well, a trucking operation is profoundly physical. It's not a software company. You are literally accelerating the decay of your main assets. Every single extra kilometer you run adds wear and tear, it burns expensive fuel, it shortens tire life, and it pushes your vehicles into expensive maintenance cycles much sooner.
It's like driving a car that has a cracked engine block. Every mile you drive doesn't just use gas. It actively damages the engine more.
That is the perfect analogy. So if your profit per kilometer is already at zero or even negative because of these structural issues,
Then doing more kilometers just gets you to the end of the road faster.
you're just draining your physical and financial reserves faster than revenue can possibly refill them. And this is the core shift we need to talk about. Financial restructuring moves the focus away from just how hard you work.
And puts it on how money flows through your business.
The efficiency, the sustainability, the actual structure of that financial engine.
So let's decode that then. What does restructuring actually mean in this specific environment? It's not just shutting the doors, is it?
No, not at all. It's not about mass layoffs overnight. It's about stabilizing the ship, getting control back.
It's forensic work.
That's a good way to put it. It is. The sources break it down into a few key areas for transport. First and foremost, you're managing cash flow timing and pressure points.
So looking at when payments come in versus when all the big bills, diesel, payroll installments are due.
Yes. It's about creating breathing room. So you're not just reducing debt, you're renegotiating the timeline to match the reality of your operations.
Okay, what's next?
Second, you address the debt structure itself, maybe right-sizing repayments on certain trucks to match what they can actually earn. Third, you tackle the cost mismatches.
This is where the volatility really hurts, right?
Yeah.
You signed a fixed-rate contract 6 months ago, and now a diesel spike has made it unprofitable overnight.
Exactly. A healthy structure can absorb that or renegotiate. A failing one just breaks. And crucially, restructuring analyzes your asset utilization versus your asset burden.
Explain that distinction.
The burden is just what it costs to own and finance your fleet. Utilization is how efficiently those trucks are actually making you money. Are you carrying too many trucks that aren't performing but are still costing you every single month?
That's a huge sunk cost. It's not just the payment. It's insurance, licensing, just parking the thing.
Absolutely. And finally, the goal is just better visibility. It's all about aligning your financial strategy with the on-the-ground reality of trucking. And our sources, especially the ones focusing on, high volatility regions.
Or 60 or 90-day debtor days are normal.
Yes. They confirm that you have to bridge finance and operations. This cannot be just a spreadsheet exercise done in an office.
Right. It has to account for those long debtor days where you're basically acting as a bank for your customers. It has to understand maintenance spikes, fuel volatility. You have to know the wear and tear cycle of your actual fleet to fix the balance sheet.
But if we tie this all together, all this forensic work is frankly meaningless if the timing is wrong. The sources are so direct about this. The single biggest mistake operators make is waiting too long.
So what defines that critical window? When is restructuring most effective? I mean, when do you still have the most leverage?
Leverage exists when you still control the assets in the narrative. That means, 1, the trucks are still on the road, earning something, even if it's strained.
Okay.
2, and this is critical, you still have active customers who are paying you. If they sense instability and start pulling contracts, your leverage just vanishes.
And I'm guessing your relationships with suppliers and financiers matter a lot here.
They're paramount. You have to retain credibility. If they still believe you have a credible plan, you still have options. Those 3 things, operating assets, an income stream, and credibility, that's your leverage.
So for anyone listening who thinks they might be in trouble, the message is that acting early gives you the power. You get to dictate the terms because you still hold all the cards.
Contrast that with acting late. Then you're just reacting. Once a supplier cuts your fuel line, or a bank freezes your accounts, or your best trucks are about to be repossessed, you've lost all initiative.
It's the difference between leading the change and just being subjected to it.
Yes, being subjected to a liquidation process that someone else decides for you.
Okay, let's finish on the outcome. If a leader sees the signs and acts, what are the real tangible benefits beyond just, staying afloat?
Oh, they're profound, operationally and psychologically.
Here.
Tangibly, you get cash flow clarity. Finally, you know exactly where the money is going. You end that stressful feeling of being busy but broke.
And that clarity, that must reduce the stress the constant firefighting.
It does. You stop operating day to day, just putting out fires. You can lift your head up and actually start planning for the future
And
again.
make better decisions.
Much better commercial decisions. You can assess contracts based on facts, not hope. You can protect your core assets, preventing the unnecessary loss of your best trucks and trailers.
And it all comes back to restored confidence, regaining control. This brings us to a really crucial reframe that the source material offers. Doing this, restructuring, it's not a sign of failure. It is an act of leadership.
That is the essential takeaway. The businesses that survive long term are the ones willing to face hard truths early. They adjust their structure before the damage is irreversible. That's what strong leadership is.
So this deep dive really confirms it. Financial health in transport isn't just about effort. It's about structural alignment. And timing is everything. That moment you decide to act is your ultimate point of leverage.
Absolutely. And if we know that intervening early protects your assets and restores your ability to plan, then the question leaders should be asking themselves isn't just how's turnover, it's something else.
That's that.
What are the leading indicators I should be tracking every single week? Things like cost per kilometer variation or the percentage of my revenue tied up in debtors over 60 days to make sure I never, ever lose that leverage again.
A great point to reflect on. Thanks for diving deep with us today. We'll catch you on the next one.